I think we're live. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor, our special guest today. No video, but he is here in voice and spirit. Value Stock Geek, what's up?
Hey guys, thanks for having me on.
Welcome back.
Thanks.
Um, for the folks who don't know, Value Stock Geek, give us your investment philosophy.
Those who have been living under a rock.
Sure. So I run a Substack where I analyze a company every week, and I'm basically looking for quality companies, and then I'm trying to identify the cheapest names in that universe. It's a lot like the magic formula, but there's more, I think, qualitative work that goes into that. It's just not systematically selecting the wonderful companies, and then the quantitative component is more about the valuation.
And so what sort of
Um,
things have you looked at? What sort of names have you looked at?
Yeah, what looks
yeah,
good right now?
well, over the years, I mean, I've been able to pick up some really good names at cheap prices. Like I was able to pick up a lot of good tech companies actually in 2022. That was like Taiwan Semiconductor and Meta. I was able to get those at like 10 PEs and that kind of thing. Um, Nowadays, those are obviously not cheap anymore. Nowadays, you're seeing a lot of liquor companies actually are popping up a lot in those screens that I've been running. I'm about to do a rebalance in early January, and it looks like a lot of those names are going to enter that universe, like Brown Forman and Diageo,
Uh,
um, where there's been a lot of talk about how Zoomers aren't really drinking as much as previous generations, and you also saw sales decline after COVID. There was a big spike during COVID, and now it's kind of returned to normal. And I think people are just extrapolating that trend. So I think that's what you'll see a lot of these days. But yeah, overall, I think there's a lot of interesting little opportunities out there.
I
the
saw it.
drunk pig and the python. Is that is that a thing?
Maybe, maybe.
I saw a note that alcohol consumption is back to like 1930s levels or something like that.
What they're in prohibition?
Well, prohibition's isn't that the 20s? No, that's the
Uh,
roaring 20s. I don't know.
Yeah, yeah, the 20s, and then they repealed it in 32. I think it was one of the, or 33. It was one of the first things FDR did after he got elected was repeal prohibition. Um,
So are we drinking as little as we did in prohibition?
the charts I've seen go back to the 60s, and
Okay.
we are at a low, but if you kind of like zoom out, it's more of like we're down 3% or something from total alcohol consumption. But
We're
I
down
think
3%.
yeah, I think people read into it like they're saying Zoomers don't drink, and I don't know if that's necessarily true. There is a lot of concern that marijuana is crowding out alcohol spending. Um, that's a big concern as marijuana becomes more legal. But overall, I mean, I think things are pretty stable. I think people are still going to be drinking alcohol 10 years from now, maybe a little bit less. But I don't think there's been this mammoth societal change. I think it's more just about alcohol consumption got really hot during COVID because people were locked up and sales went through the roof, and now they're kind of normalizing and maybe people are adjusting their habits a little bit. But I think it'll go back to normal.
Used to be this idea that booze was pretty recession resistant because when people go through bad times, they tend to drink more.
Yeah, let's get the unemployment numbers up, and then that'll then the booze will come back.
Is it crowding out by weed, or is it a lack of money in Zoomers, or is it like a everybody's online and they've seen all the studies and they've decided that they don't want to drink as much? What do you think's the
Mm.
causing that little trend, that little down drip anyway?
I really think it's just about um, things getting to things reversing after COVID. I think
Okay.
it's really just more about that. I do think those longer term concerns are valid and are something to keep an eye on, but I don't think there's enough evidence to say that people have really significantly changed their habits. Um, I think more of like people are looking for an explanation for the price action, and they're creating these narratives like Zoomers don't drink, they're just looking at the screens all day and they're not going to bars anymore, and everybody's replacing marijuana with alcohol. And I think it's just like they're just crafting a narrative that I don't really think there's some truth to it, but I think it's being exaggerated.
Is it impacting any part of the market more than any other? Like how do hard liquors, spirits hold up against beer and things like that?
Yeah, I mean, there was a ton of interest over the seltzers. Like I know in the early 2020s, like if you look at Sam Adams stock, that went through the roof because of their hard seltzer brand. Yeah, and I mean, I think that's just more of an alternative to traditional beer. I think the alcohol companies are adapting and adjusting to that. And then there's the traditional spirits, which is like more of Diageo and Brown-Forman's wheelhouse.
It's funny how many charts went crazy through that 2020, 21, 22 period and have come back to earth, and how it's hard to tease out from that, like what is secular and what is part of that. I don't know whether 22 pulled a whole lot of demand forward or it was just a whole lot of stimulus through that period.
Yeah, you're right. There's so many charts that look like that, where it is really difficult to discern what's a secular trend, what was just a COVID thing, how things are things just returning to normal. And I mean, you can see it in all kinds of things. You can see it in, I mean, we saw it in lumber. That was a
Yeah.
pretty good example.
Yeah, I remember that.
Yeah, where there was this big spike, and then again, there's a narrative that goes along with that. Oh, we're in a housing shortage, and lumber prices need to go up, and blah blah blah. I feel like anytime you see something do well or do poorly, it's almost like people make up some secular trend to go along with it, and it's usually not. It's usually just a cyclical thing.
The narrative follows the price every single time.
Pretty much, yeah. And today, I mean, you're probably seeing with AI, there's probably, I don't know if AI is necessarily the kind of secular trend that everybody seems to be convinced it is. And then I'm sure if AI spending goes down just a little bit, it'll be, what a waste of time. This was just nonsense. And, you know, the truth is probably somewhere in the middle.
Right. There's quite a few companies that I would imagine there's some names falling into your quality and cheap bucket that had been quality and expensive for a long time, and now all of a sudden are starting to look a little bit more attractive. Is that accurate?
Well, that's the thing. So every week I look at a company and I would say 90% of the time it's too expensive. But it's all about just constructing this big universe of quality companies and then trying to identify them when they're a little beaten up. There were actually a lot of last year, at the end of the year, there were a lot of good defense names that were good. My screen picked up Huntington Ingalls, which builds the aircraft carriers and that kind of thing.
Yeah.
And there was concern in Q4 that there were all the issues that were happening with the budget, that that these contracts wouldn't be fulfilled, and that all turned out to be nonsense. And now the stock is up 70% just by reverting to the mean. And there's a lot of things you see like that happen. I mean, it's the same thing with tech. Like I looked at all the tech companies in the beginning of the Substack in 2021, and at that point I said these are all too expensive. And then lo and behold, a year later, Meta is at a 10 PE, Taiwan Semiconductor's at a 10 PE, Google was like a 15 PE back then, which is cheap for Google. But you'll see a lot of that. A lot of that stuff happens. People get convinced it's a secular compounder. I'll add it to the universe because there is some truth that the business is good. And then you just wait a little bit, and it usually doesn't take that long. And all of a sudden, this is cheap again. And then it's at a moment when everybody thinks that, oh, it used to be a compounder, but now it's garbage. And it's usually not. Sometimes it is, but usually when you're looking at a lot of these really high quality companies with moats, usually they just go through cycles, and it kind of baffles people's minds when they do.
Does something like, I'm just going to use Copart as an example, but historically a pretty amazing business, but was always very expensive. Now let's call it a 23 or something PE. Are they interesting at that level for you, or are you really waiting until it's like they're down in like a 10?
No, so I look at, one of the big things I look at is price to sale, is trending in price to sales. Okay. So what price to sales ratio does this normally trade at, and what does it trade at now? That's like a key metric I look at. And so that keeps me from saying like I need to get super deep value where like some companies will never trade at a 10 PE. But if you have some like Copart is a good example of a company that may not get that low. But if you look at trending and price to sales, you can identify these inflection points when they might be a little bit cheap. So yeah, usually I rank everything by discount to its typical price to sales ratio, and I rank all the companies by that criteria. And then I'll look at absolute earnings yield. So I'll say like, is the earnings yield at least maybe in excess of the current 10-year treasury yield? So, basically today is like the P is the enterprise multiple below 20, and is the price to sales, and then rank that by the price to sales discount to where it normally
trades. Are you
trades.
using price to sales because it's such a clean metric? Like there's not a lot of counting shenanigans between revenue and revenue?
Yeah, and I've noticed for a lot of these companies, price to sales, like you're right, sales is more stable. But what you can really pick up there are cycles in margins. So you look at margins and price to sales for a lot of companies, and often it looks like a wave, and you can identify points where, okay, this is probably just a cyclical phenomena and it's trading at a super low price to sales multiple because margins are temporarily depressed. As opposed to, and I think that's better than what the traditional magic formula does, where it's only looking at trailing 12-month ROIC. Because I think what that does is it tends to identify companies at cyclical peaks, which is why, as Toby's research has proven, that tends to underperform pure value. And I think it's because it identifies a lot of those companies that are trading at cyclical peaks. Like I remember looking through magic formula screens, and things would pop up like that, like Cal-Maine 2015, the egg producer. That was popping up on the magic formula screen. And it was mainly because I think back then there was another bird flu and prices were high. And well, what happens? Markets work. People, egg producers will create more eggs and prices will eventually come down. And then it identifies a lot of fads like Fitbit. Like that was another one that was in there.
Right. Yeah, it is prone for hula hoop behavior.
Have you seen those charts on margins? I post them occasionally. S&P 500, 400, and 600 over like the last 20 something years.
Just up and to the right, or
it's amazing. Yeah, the margins are 13 or 14% for the S&P 500 on average, which is just extraordinary. Even mid and small are elevated well beyond their long-term averages.
Yeah, and I guess the question is that going to continue or is that going to mean revert? I don't really know. I guess you could argue that there's less antitrust, that these tech companies are different and nobody is doing anything to capture their market share. On the other hand, you could say it's a mean reverting series and all these companies at the top are in for some trouble. I'm not sure if I know the answer.
It has been a mean reverting series. I don't know if it is. It's one of those things that's Buffett and Hussman and Jeremy Grantham
takes its sweet time to mean revert, doesn't it?
Yeah. I think someone said 6%. I think Buffett says 6% is.
And Grantham, both 6%.
It's like an unusual number. And here we are, we're talking 13 or 14%. That's crazy.
So I've tried to play the devil's advocate because my own natural gut instinct is also like, this is not sustainable. Like everyone's going to get cooked. These are crazy. So I'm trying to temper that a little bit with running a counterfactual. But so what would I need to believe about the world to think that not only is 13% the new normal, but maybe we go higher? I heard or I read about Michael Dell talking about AI potentially adding 10% productivity. I don't know exactly what that means in an income statement, but let's just assume that it's taking 10% of cost out. And let's say that let's just imagine this crazy scenario. What if public companies, all companies, were able to run at 20% margins? Then what? Is this actually is the market relatively cheap today in a 20% margin 2027 world? And what would be a reasonable multiple for a 20% basket of companies? 30 times earnings, 40 times earnings? I don't know. That maybe. And therefore,
you might be clipping this up in 20 years' time.
Yeah. Right. Yeah, these bold macro predictions by area economists. But I don't know. I'm just trying to like temper my own biases, which I know are more towards the like this is all bullshit and is going to come crashing down.
Does it come out of labor? Is that the other side of the coin?
Well, and I mean, and of course, like the counter to all this is like, okay, um, yeah, so now we fire half the workforce. Is that what we're saying? Like, where's the demand for these products now if you half the people are unemployed? Also, assumes that like no one is going to compete ever again in business,
Yeah.
which, like, wait, I got 20% margins and I see that you have 20. Well, maybe I'll take 18 and I'll
Yeah.
take some of your market share. And then you go, well, hold on, I'll take 14 and then I'll take some of your market share.
That's how
At
it's
some
supposed
point,
to work.
that's how it's supposed to work, right?
Yeah, that's how capitalism is supposed to operate, no doubt about it. But yeah, I mean, I have the same biases. Like my gut says this is a mean reverting series, but like you, I also thought that 7 years ago, 8 years ago, and it doesn't seem to be
Yeah.
reverting. So I don't know. Maybe it's just that these tech companies aren't being reined in by any antitrust anymore, and they're eating up a lot of other businesses. They're destroying a lot of businesses along the way. You could argue that's a good thing, a bad thing. I don't know, but it seems like they're dominating a lot of. They're going in and they're taking away a lot of, like, advertising businesses, for instance, are basically
Mm,
getting destroyed by Google and Facebook, and that's been going on for a while. And you know, those were
Yeah.
businesses with certain margins, and they're consuming that. And that I don't really see what is the competition that's going to change that. It's hard to imagine at this stage of the game,
Well, aren't
even though
they
that's what
all
history.
coming to compete though on AI and they had their cozy monopolies before where they sort of didn't try that hard against each other in their space and then it feels like they're all kind of heading towards one goal, which would be to win the AI world, which to me seems like okay, now the elbows get a little sharper and maybe there's actually competition.
I
Yeah,
feel
I
like
mean, maybe this is the catalyst.
I feel like AI is like protein. It's like it's in everything these days. Like you try to buy any kind of thing, it's got additional
Cupcakes, stick
protein.
protein in there.
It's got some AI in it. You're like, well, what am I going to do with that?
Get swole, Toby. What do you mean?
Gmail keeps on trying to get me to AI my email account. I'm like, dismiss, 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 go away.
Uh,
Yeah,
But
and I don't even know if what we have as a what we're calling AI is really AI. I'm not an expert on the subject by any means, but
that's
like
the marketing. That's the label, the advertising.
it kind of seems like maybe this is just like searching the internet and plagiarizing shit. Like,
I know a lot of it does feel that way, isn't it?
It's brawn dough. It's got electrolytes in it.
It's what plants crave.
like, is this really HAL 9000 or data from Star Trek? I don't know. I'm not sure if it's that level yet.
A little bit of a non sequitur. Have you followed AutoZone? AZO? AZO is the ticker.
Yeah, great company. Yeah, AutoZone and O'Reilly, they're both really
Yeah.
good companies. They have a great little niche. They buy back tons of stock.
Yeah. I mean, that's their business, isn't it? Buying back stock.
Yeah,
And business is good.
I I saw that AutoZone took a whack today, or has over the last few days, I thought, because
Perfect, cheaper buybacks.
yeah, though that was my initial thought, but the point of the tweet that I saw was that they've managed their payables and their working capital to create a lot of the money that they use to buy back stock. And with First Brands and those other companies falling over, like that they may not be able to play that game anymore. And I think that's the reason why the stock has been hammered today.
Mm.
Do you have a view, VSGU? Did you ever dig into that enough to sort of,
I did. I wrote them. I've written both of them up, AutoZone and O'Reilly. I didn't know AutoZone had a big decline today, but if that's the case, I wouldn't be surprised if my screen picks it up at the end of the year because it's in that universe of wonderful companies. Um, and I don't really, once it shows up there, I don't really question it. I'm going to buy the 15 cheapest companies in that universe. I do trim the universe, but I'm not going to exclude something because I think it's secular or that the trend has reversed or whatever. I'm going to trust the process and
So
it'll
the
probably, the stream will probably.
argument is they're using working capital as a source for buybacks.
That they've been freeing up cash flow in every single way that they can, and one of them is by, you pay your suppliers layer
Sure.
and layer,
I mean, you could
and
do that one time, but that's not,
you can
you know,
extend it. You can, yeah, that's right. You're right. But at some point, yeah.
and then it
Hmm,
unwinds when you,
But the
but
collapse of First Brands is going to impact them. It
mm,
changes their financing.
interesting.
I'm not over enough to know. I just, I like I like companies that buy back a whole lot of stock. And so I'm just wondering if that impacts anything else.
Yeah, I'll have to take a look at it and see if that's true. But yeah, I also like companies that buy back tons of stock. That's definitely, I always look at, one of the things I'm always focused on is shareholder yield. I want to see a really
Yeah.
decent and growing shareholder yield. And if you do really look at any company that has bought back a significant amount of stock over the last 20 years, almost always you get a pretty really good result for investors for any kind of company that does it. Sometimes it's like a delayed reaction, like you see that with something like Dillard's. Like
yeah,
they bought back stock for 10
comes
years
in
and
a
then
non-linear
boom,
way.
and then it just all happens at once. It's all like a coiled spring there.
They got a little bit lucky with COVID. I think there was some stimulus that flowed through, and that was a big part of that.
Yeah,
Good,
That was the
absolutely.
catalyst.
good things happen to cheap stocks, Toby.
Yeah.
Or not sometimes.
I, I've said that. I don't know if that's true, but I hope so.
If you say it enough times, it might come true.
Um, Before we came on, we were talking about Palantir and Nvidia, their reactions to Burry's. So Burry's got a new Substack. You guys have taken a look at the Substack.
Read one of them so far.
I
Did
have.
you?
I read one article. Yeah.
What was his Palantir Nvidia? What is his Palantir Nvidia thesis?
It's around stock-based comp and that they're aggressive with that. And if you do an actual kind of owner's earnings look at it, like Nvidia's trading at more like 60 times and not 30 times, if I remember what he said correctly.
That's a sin around here these days. Is it like paying a whole lot of SBC?
I know.
That's just business, isn't it? 15% a year goes out the
Well, and
door in SBC.
that's exactly right. Like it hasn't mattered for at least the last
10
10 years.
years.
Yeah, I mean it's like, okay, well, cool. You could be technically correct, but no one who cares. Like it's
Yeah.
going up. It doesn't
Yeah.
matter.
You like accounting or you like to make money?
Yeah, exactly. Do you like
Yeah, and
owner's earnings? Or do you...
he really seems to think that this is a lot like the late 90s. I remember he talked a lot in the article about basically comparing the current era to when he started his blog, I think around 97 or something, when everything was really getting going. And at the time he was living in, the epicenter of the tech bubble. So he was surrounded by it all. So he seems to think that the two environments are very similar.
97. Nobody's got the balls to say 99. Nobody's got the balls to say March 2000.
Yeah, well, he
Everybody's
was,
like, it's 4 years away.
But that was one of the interesting things that he talked about was that the spending, the CapEx, didn't peak in March of 2000 like the market did. It peaked like a year or
A
two
few
after
years
that.
after, yeah.
The market had already like given up and fallen off a cliff while the spending was still happening. So even if maybe, we have this big runway in front of us that everyone can see of AI CapEx, maybe the market doesn't, it looks past that and it looks down the slope from there. I mean, who knows, but I think that was one of his points.
yeah, and I remember Cisco traded at like, I think it was 50 earnings, 50 times earnings at the peak or something. And the company did very well, like the business did very well from 2000 to 2010. It grew, I think it tripled or something. But stock was dead money because,
I think it took out its
it's
all-time high, like in November.
When it said it was an AI play.
25 years, 25 years it took
25 years for a business that
took out
has
the all-time high.
probably grown, I don't know, over 10% a year for 25 years.
I mean,
It
I'm a
should be a
patient
much
guy,
better.
but that's a
Stock
long time.
prices stock prices can get a little ahead of themselves.
They can.
Ain't that the truth?
I mean, I think that was the thesis that the Nifty 50 have ultimately delivered like nearly a market perform since the Nifty 50 were founded in, whatever, the 70s sometime. Even
Yeah,
though they got ahead of themselves in the 70s, like they fell back. There was you were dead money for 50 years or something in the interim.
that was Jeremy Siegel wrote a paper
That's
about
it.
that.
Yeah.
Yeah, and I think he did it in 92. And he said
Okay.
if you bought them, they all recovered. But at the same time, it's like, okay, you had like an 80% drawdown and you just delivered a market return. I don't know if that's a great result. Like I'd rather buy the Nifty. But to his credit, it is true that those companies continue to compound in value. But my takeaway from that was, well, then I'd rather buy the Nifty 50 in 1975 versus 1971,
Yeah.
and
I
you'll
think
get a much better result.
wasn't like Philip Morris drove like 50% of the results or something of that too. So like if you took that out, if you didn't hold that through the whole thing, like I don't know if you ever made it. I could be
Yeah,
wrong about
that's
that, but
no, that might be true. Yeah, I mean, there were a lot of really good companies in there, like McDonald's was in there,
yeah,
Xerox.
Kodak, bunch of really
Yeah, then there's the duds like Polaroid and Kodak. That's true.
I mean, they weren't duds. They weren't duds
no
until they were crushed. They were pretty strong for a long time in
hot
there.
shit for
Yeah.
they were the modern equivalents.
Yeah, I read once when Buffett brought Bill Gates to one of the meetings of, he would have like Walter Schloss there and all his friends.
Yeah.
And I remember he wrote that they asked Bill Gates about Kodak, and Bill Gates said in 1991 or so, Kodak is toast. Like he saw the writing on the wall at that point, which no one else really did yet.
Hmm.
Because I think it was trading at book value or something in the early 90s. I guess it worked for a little bit until it didn't.
I want to know who picked that cameras were toast because it seems like as much as that destroyed film, like it was really the phone that destroyed cameras because there's just no reason. Like the cameras on a phone are so good now, and that
Could you imagine
utility would
buying
be.
a regular camera nowadays and bringing it with you on vacation?
I mean, it's like a steampunk thing, or it's like you're doing it for the look.
Yeah, yeah.
It's fashion. It's not like it's functional.
Yeah, absolutely. I don't know anyone who does that. But yeah, I remember that. Like when I was a kid, my dad had the huge camera with the strap and everything, and you go on the family vacation. And
Yeah. Half
yeah, it
the
was a big,
pictures are like eyes are closed or like it's just out of
Yeah, like
focus.
a month after you take the photo, you get the film developed, and then you
Like,
figure out what happened in the moment. Yeah,
yeah, I remember those little, there'd be like these little like closet stands in mall parking lots where you'd go and get the film developed. You remember that?
yeah,
Like we
yeah.
were,
yeah.
yeah, and then you
Now
just
they're all
drop it
Dutch
off.
Bros, coffee shops. It's not.
Yeah.
Is Dutch Bros still going?
Oh yeah.
Is Dutch Bros still a is Dutch Bros still a popular stock? Do people still talk about it?
Not as popular as it was on the IPO, but
Yeah,
I mean it's still probably legit. I don't know. I remember when it first came out, I looked at it and I was trying to underwrite like what growth rate was implied in the current price. And it was like basically you had to know for sure that it could go east of the Mississippi successfully. And brands just it's hard to tell if brands are gonna can go national or not. I mean, See's Candy couldn't push that direction, but it was killer in California. Dr. Pepper is like 20% of the soda market in Texas, but like
yeah.
1% everywhere else. Like there's no guarantee that brands can travel. And so that seemed like kind of a dangerous bet to me when I looked at it.
There's a
Hmm.
psychological component to taste
Mm,
that in chocolate and soda and stuff like that that's just insurmountable. If you didn't like get exposed to it as a kid in a happy scenario, then it just doesn't.
it didn't
There's
take,
nothing
yeah.
special about it.
And
Yeah,
what you
Buffett
need
talked about. Oh, go ahead.
no, no, go ahead.
I was just saying Buffett talked about that with Coke. Like you went to baseball games as a kid and you remember the taste of Coke. Same thing.
I was gonna say it's easier though when it's like enough caffeine and sugar and fat to like,
Yeah,
kill a horse, then
yeah. Those are keys.
does help. Yeah.
Like some addictive component. Let me give a shout out, and then JT will take it away.
Wedgies.
Brown Maribozo. Is that
S-
Toronto? Tomball, Texas. Tyler, Gothenburg, Sweden. Petitfar, Lausanne, Switzerland. Tallahassee, Jupiter, Florida. Surbiton, London. The main streets of Jared's Cross. I love it. Yorkshire, England,
Pudding.
Nashville, Tennessee, Toronto, Havertown, Pennsylvania, Bellevue. I saw a good one down here. Valparaiso, Snohomish, Pforzheim. Am I saying
Oh,
that correctly?
stay dry
Germany?
there. It's quite wet in Washington right now. Good luck.
Is Pforzheim, is that where is there a racetrack in Pforzheim? Am I forgetting? Let me know. That's a good spread. That's fun. Thanks, everybody. JT, take it away.
All right, today's veggies are a synthesis of actually two fascinating recent reads that I had. And the first was called Collective Hallucinations and Inefficient Markets. And it was a deep dive into the neuroscience and psychology of hallucination and how the brain is constantly predicting and reconstructing the world, and how perception itself is basically like this controlled hallucination. And really, they arise from these predictive signals that kind of drift away from grounded sensory feedback. And then the second was an interesting piece that was about AI as the new shadow banks. And these obviously couldn't be more different on the surface. The second article explored the financial ecosystem growing up around the AI infrastructure, chip supply chains, data centers, credit structures around them, all these speculative expectations around compute demand, and the way that capital markets are behaving, almost like a new shadow banking system that we kind of had in the derivative world of mortgage-backed securities in 2008, for instance. And so as I'm reading them, like something kind of clicked together about them, and I thought I might share that. And really, one is about brains hallucinating, and the other is about markets hallucinating. And they're actually kind of describing the same phenomena, but at different scales. So both the mind and markets are predictive engines. They're both constantly guessing about what comes next. And they both hallucinate when prediction outruns reality. So today we're going to explore this kind of extraordinary parallel between these systems. And there are really 5 core ideas that I want to use to tie everything together. And those are overbelief, illusions that become real, narrative gravity, sensory poverty, and why hallucinations sometimes can drive progress. So we'll start with the first one, which is overbelief. And in neuroscience, hallucinations don't appear because the brain is malfunctioning. They appear because this predictive machinery, it becomes too confident. And it's always filling in these missing information pieces and constantly smoothing out the gaps in sensory input. So for instance, like you've got a literal blind spot where the optic nerve exits your eye and connects to your brain, and there's no sensors there at all. And yet your visual cortex just paints over that whole area with so cleanly that you never even notice it. Like it just fills in the gaps. And under normal circumstances, reality is constrained to those predictions. But when those constraints get weakened, the brain leans harder on its prior estimations. And so it trusts its own internal model more than the external world. And that's what overbelief is. So now let's think about AI. An LLM works in a lot of the same way. Like it's trying to predict which is the next token. And, whether it's grounding data is weak or absent, retrieval isn't available, the model leans harder on its statistical expectations. And it fills that gap in with patterns that kind of quote unquote make sense internally, even if they're maybe not true. And that's how we end up with hallucinations. And then in markets, perhaps the most powerful overbelief machine, investors predict future revenues and earnings, and companies predict future demand for things, and governments predict future technological competition. And when real cash flows or sober feedback is thin, markets become trusting of their own narratives at that point. So AI infrastructure with chips and data centers, power buildouts, it's getting financed today not because the demand is known and verified. It's because the expectations of demand are so strong. And when these internal predictions outweigh the external constraints, all 3 systems, the mind, models, and markets all hallucinate about it. So the second idea here is is illusions that generate real consequences. So in humans, hallucinations don't just stay in the mind, they trigger bodily reactions. If you hallucinate a threat, your nervous system is going to respond and queue up as if that threat was real. Your body really enacts the hallucination. The financial system takes this phenomena to the next level, which is investors believe in this unstoppable demand for compute. Billions of dollars are flowing into GPU factories, et cetera, cloud providers. And this ecosystem reinforces everyone else's belief that this is a real thing. And then something really astonishing happens, like that belief becomes infrastructure. We have it now, like it gets built. And that imagined future becomes a physical one. And even, AI kind of participates in this loop as well. Like a hallucination, maybe, but with a persuasive explanation, gets posted online, and then later future models pick up, they scrape that and they turn that into a factual source. So you're kind of like bootstrapping yourself into a belief or what is quote unquote true. So in each case, whether it's a brain or a model or the markets, these illusions escape the confines of prediction and alter the world itself in a reflexive way. And so let's jump to the next one. This is what you might call narrative gravity. And this is the idea that, there's this pull towards stories that feel coherent. We all want that. And it shows up everywhere. The mind is instinctively looking for patterns and explanations. Even, with incomplete sensory input, it stitches together a narrative that will make sense internally. AI does the exact same thing with trying to hit optimization targets. And then in markets, narratives are even more powerful than numbers often, and the story is often the asset, right? Like this compelling narrative, AI will transform everything. Compute is the new currency. GPUs are the new oil. That attracts capital long before the revenues ever appear. And that narrative gravity explains why hallucinations become so believable. And then the fourth idea is this idea of sensory poverty. So an environment where there isn't, like, let's say, darkness or monotony or sensory deprivation, you will then, that sensory grounding in the external real world is weakened, and the brain will then generate its own version of what reality is, right? That's why you see the monster in the dark. AI systems also do the same thing when they're, when feedback is scarce. They'll skip citations and retrieval and just come up with something. And the model's running kind of in free mode, and its output, is kind of creates its own input and it just like goes off on its own. Financial markets, they do the same thing. When fundamentals are weak, if in early technological cycles like AI, the actual revenue today is tiny. Customer demand is totally uncertain. Unit economics are immature. Like we have no idea what it actually costs to run all these tokens. We must extrapolate then out from this very sparse data. And in the absence of a sensory feedback, the narrative becomes the only thing that really matters. Eyeballs during .com is a good example of this. All right, and then now the fifth idea, and this is the maybe more surprising and maybe optimistic version of things, is that these hallucinations often are how progress happens. Creativity itself is, a structured hallucination. The brain's ability to imagine what does not exist is what produces hallucinations under stress, but it also leads to creativity. AI does the same thing. It can be a source of novelty, which is actually pretty impressive. The models can make these leaps that maybe humans hadn't thought about yet. And in finance, hallucinations are this kind of hidden engine maybe behind a lot of the major infrastructure revolutions. People are speculating to fund railroads that are still in use today, speculating to build fiber optic cables that we're still using today, speculating on electricity grid decades before there was any profitability, and the same thing with cable systems in the 60s, 70s, 80s, and all these things happened, and maybe it's happening today with AI and compute, and even if the demand collapses, maybe the infrastructure remains, and we're all going to be better off for it. Now, of course, we'll leave this we'll ignore the depreciation schedule controversies around all this that maybe throws a wrench in that, but let's zoom out a little bit and kind of wrap this thing up. What we've covered is a shared architecture across systems that seem unrelated. Brains hallucinate perceptions, AI models hallucinate language, and markets hallucinate future cash flows. And all three are hallucinate for the same structural reasons. They're predictive engines operating under uncertainty. And when predictions outrun their grounding, when feedback is weak, when narratives are strong, these hallucinations appear, not maybe necessarily as malfunctions, but as the natural extension of inference. And the deeper insight is really this, that hallucinations aren't errors maybe to be stamped out necessarily. They're really how complex systems feel their way into the future. And even as they distort and misprice, and sometimes people get hurt. The job of an investor in this AI cycle, I think, is to stand inside these hallucinating systems, minds, models, markets, and keep asking, is this the kind of illusion that leaves useful infrastructure behind, or is it just another story that ends up on the shelf of the library of mistakes, which we talked about last week?
Good one, JT. It's a hallucination if it turns out not to be true, but it's a vision if it turns out to be
That's right.
accurate.
And if you can figure out the difference a priori, then you'll do well.
You're the Messiah.
Yeah, exactly.
Are there other animals that experience hallucination, or is it a uniquely human thing?
I would imagine that other animals, I don't know for sure, because I think it's kind of hard to tell subjectively, but I would imagine that there's hallucinations in other animals. I mean, they're making predictions the same as we do about their environment. Um, I mean, other
Yeah,
animals dream, so that's probably another data point that might be pointing in the direction of hallucination.
gotcha. Yeah, I just was wondering if maybe there's a unique human thing towards trying to visualize and predict the future that's unique to us. Um, like
No, I
maybe,
mean every animal has a working model of their environment and kind of how they fit into
yeah,
it, and there's that that expectation is always crashing against the sensory input to see like what surprise is, which is like, oh, my model is wrong,
gotcha,
I need to update it.
gotcha. Okay, interesting. Well, a lot of it sounds like an explanation for the momentum factor, if you think about it.
I posted about momentum factor today. It's been very, very strong. It's been, as you'd imagine, it's been strong for a very long period of time, but it really took off in 2000. I contrasted it with the equal weight versus S&P 500, which has collapsed,
Mm.
relative
Oh,
to the market capitalization weight index, which is up a lot, which is why it looks like it's collapsed. But just the average stock is not doing very well, while the big end of town is doing very well.
If you had to bet, if you were a betting man over the next 10 years, would you bet S&P 500 market cap or equal weight?
I'd bet equal weight because if you can look back over 100 years, it's clear that small beats large, and equal weight is just one expression of that. You can create the same chart with like S&P 100 versus 500, where in that instance 100 is the large, like 500 is the large relative to the equal weight. Like there are a lot of charts, I think we've discussed this before, where you've got to decide whether you want to see, do you
Mm.
want the thing that's worked over 100 years or do you want the thing that's worked over the last 10? And I think
Yeah.
you can see, like I posted another chart today, which was the Russell 2000 versus the S&P 600. So the 600 is the small cap index, and it is the 600 that's outside the 900 that includes the 500 that's large and 400 that's mid. And so there is like 500 stock potential overlap with the 2000. So they're not directly comparable, but there's some overlap. The big difference is that the S&P 600 has these profitability requirements for inclusion in the index, whereas the 2000 is just all comers. And the 600, as a result, in sort of a little bit of a defiance of that large over small, because this is the profitability factor is so much more powerful here. The 600 has massively outperformed the 2000 since like 1990. I think that chart goes back to, so it's 35 something years. But you can clearly see in it there are these like distinct little heart attacks in 2000 where there's a massive spike to the 2000 over the 600, and then in 2020 there was another big spike to the 2000 over the 600, and we're currently in another big spike of the 2000 over the 600. And if you pull up the 2000 and you look at the largest names in the 2000 or representative names in the 2000, like it's a
Pretty
very, very
inspiring list of
junky index. Yeah, there's a lot of science experiments in there. There's a
yeah.
lot of stuff where they're pre-revenue. They're still trying to figure out they got a vibe, rather they got a
That's as
logo
good
and
as
some
money,
branding.
sir.
They're telling people what they're planning to do sometime in the future, and people are like, "That's a $25 billion enterprise."
But yeah, the contrast is pretty amazing. Like I was looking at the returns on like the S&P 400 and the S&P 600, and I think they're both up like 7% year to date versus the S&P 500, which is up 17%, or
Yeah,
18% now, which is pretty insane. Pretty
That's a,
insane
that's a pretty
difference.
big delta for things that are not that far apart from each other otherwise.
it's
Yeah.
very much a size-driven market. The bigger the company, the better it's done. But I don't know if that's because when you get these like technological revolutions, you get new companies going to the forefront, and that's what drags the whole index up. Or if this is like a 2020 style, just a
Shitco
we
rally.
we call it a meme stock market, but it's like every boom is a meme stock market because there's some narrative that drives interest over, the underlying fundamentals delivering or generating the returns. And so we're back into that kind of market right
I
now.
mean,
Mm.
if you look back at the last major bubbles, like say the late 90s, Japan in the 80s, or in the Nifty 50, pretty much all of them were large cap
Yeah.
phenomena. So it makes sense that that's what would be happening now.
But has the meme moved into the large caps in this instance, in the sense that like
Mm.
the AI,
Nvidia is
there's
Nvidia a
only,
meme
yeah.
stock?
Well, yeah, maybe. Like clearly there's a fundamental story there as well. It's very, very impressive on a fundamental
Yeah,
basis.
80% gross margins. That's a
Plus the
real,
growth
yeah,
and the seemingly like infinite demand, like just endless demand for these things. Like they cannot produce enough.
yeah.
But it
Did
does
it,
seem like there's a little bit of a defection from that ecosystem. Like Google's making its own chips and training them. I think Tesla is too, but maybe it's doing it with Nvidia. It's hard. There's so many announcements. It's hard to kind of figure out from the headlines what is real and what is not.
yeah, it
Apparently we're
does seem.
selling to China now too, but with a 25% rake.
For the big
Okay.
guy,
Yeah, sure. For the big guy.
25% for the big guy.
It does. It's hard to imagine that Google, Microsoft, Apple would just sit around and say, "Well, I guess we'll let NVIDIA do all this." Like, it doesn't seem like that's sustainable for that long. Like they're going to compete on some level.
Yeah.
Did
Well,
it? Did
I mean,
anyone?
the argument though, the counter argument might be, and this was the argument for Intel in 2000 to really until they started pooping the bed in whatever 2020-ish. But it was always like, okay, Intel can spend the most money on R&D and spread it over the biggest amount of fixed costs. How is anyone ever going to catch them? Like they can just
How did
spend and
anybody
spend.
catch them?
I know it's a great question. I mean, that's a $1 trillion question there
Only the
because that
paranoid survive.
Taiwan Semiconductor, they were able to do it. They were able to do it cheaper
yeah. So what's
thanks to lower labor.
I kind of feel like Nvidia's got similar, they got Intel 2000 vibes right now of like
Yeah,
Yeah.
infinite
invincible.
demand,
Yeah.
90+% market share. No one can catch them on R&D. They're so far ahead.
Did anyone listen to his interview on Rogan? I haven't, but have either of you
I
guys?
just saw some clips. No,
No.
Oh,
I
okay.
don't think I've ever heard him talk before.
What'd you
Yeah,
think?
he apparently did a crazy interview. All I've seen is the tweets about it, but apparently he claims he reads 7,000 emails a day and he needs some crazy claims.
Is there room for that in the schedule while you're signing boobs? I feel like that's like
I didn't want to mention that. I was going to say
I shouldn't have said
that
that.
that's a top.
Toby, take that out in post
When
production.
when people brag about that stuff, I find it so weird. Like I read this many books in a year. Like I would have no idea how many books I read in a year. Why would you go and count the number of books that you read in a year? That seems like bizarre behavior. Why would you
I
have
don't
that much
know.
time in your day?
And are you really
Aren't you
comprehending
reading
the
books?
book?
Yeah.
Like if
You don't even have to take your shoes off to count that high, do you?
like if you're reading that many, like when I hear people make that claim, like how are you possibly retaining the information from the book and really internalizing it?
He's getting like the Wall Street Journal headlines forwarded to him, and he's getting all of his. He counts every coupon 25% off. That's one more email read. Read the headline. All the junk
Yeah,
mail that counts too.
yeah. So it's pretty bizarre. The other thing I've noticed about NVIDIA, and maybe Toby, you would know more about it, but I've just seen the Benish M score is trending towards the earnings manipulator
Mm.
territory. Have you looked into the components of that for NVIDIA or anything?
There are lots of people out there who say that they're doing a little bit of channel stuffing and that they're financing some of their customers, and there are lots of things. There's lots of rumors like that out there. I don't know how. I don't know if you have so much demand, why you would be doing that stuff. So that is a little bit of a funny story, but the demand seems to be real.
Mhm.
But then there are those stories like that. I don't know.
I think
I
I
don't
would,
know.
if I was him, I would hit the at the money equity issuance. I mean, they're doing that with SBC right now, but I would be like, I'm gonna bring in $1 trillion onto the
Do they
balance
need it?
sheet right now.
Doesn't matter. You
Not a
just
bad
take it when you
idea.
don't need
You
it.
could always use it. I mean, you probably at some point will be glad you had it.
And in this market, people wouldn't even care.
No.
They should be outraged, but I think in this market, it makes a ton of sense, and you probably get away with it.
The only point that I get to looking at those big stocks is that they do seem to me to be they're doing very, very well.
The business or
They're
the stock price?
the business, yeah. So the business is doing very, very well, but the stock price is already, uh, discounting 25 years of, maybe not 25 years, but the stock price is ahead of them a little bit. They look expensive to me, and I don't know that that doesn't necessarily mean they crash. Like, it just means that they're a little bit more sideways for a period of time, and then there's other stuff in there where there's really not much, if you go down even in the S&P 500, there's a whole lot of stuff that hasn't worked. And then as you go further down, 400 and 600, it gets, suicidal. They're kind of they're looking pretty sad down there, and not much has to happen. I mean, oil and gas is just, are we still using oil and gas, or has the economy just moved on completely?
Pretty sure we're still using it. Yeah.
Because it looks like it's being given away for free. Like, you go and buy a bottle of water and you can fill your tank up at the same time at the.
That is quite impressive, isn't it? I've always been amazed by that. Like, you can literally move what, 1,500 pounds of vehicle 40 miles for the same price as like as water. Like, wow, that's impressive.
You got to pull it up
Yeah,
out of the ground and process it and
Oh,
then ship
boil
it.
it to oblivion and then yeah, it's amazing.
I always think about that when people complain about the price of gas, because yeah, it sucks when gas prices go up, but at the same time, you got to zoom out and think like, look at how cheap this is compared to what it allows me to do to what most of my ancestors never even could imagine. It's pretty incredible when you think about it.
Yeah, the megajoule per kilogram, so the energy density of fossil fuels is just absolutely incredible.
If we don't have jet fuel, can we fly? Like,
No,
our batteries aren't energy dense
no,
enough, are they?
no, they're like I did the math on this at one point and like they needed to be like 30 times denser than where they were at that time to get to the same energy density as jet fuel.
We are improving them. Like, I remember seeing this is 5 or so years ago now, where I saw an article that said that if you use the same battery out of an old school laptop and you put it into a modern laptop, it lasts for like a second. It just torches the battery
Is that right?
instantly. So, because there had been this article was answering this narrative that had been out there, that there had really been no improvement in battery technology for a very long period of time. And I don't know whether they meant like just literally we're still using the same style of battery, but
Yeah.
clearly the batteries are much more efficient and better than they used to be. Like, to 30 times, how far into the future is that in terms of improving battery technology?
I don't know. I mean,
Is
certainly
it impossible, or is it just like wait 10 years and we'll be doing it?
that's above my pay grade. I don't know. It might even be like much closer now. Like I wouldn't be surprised if there's some Moore's law that's happening there that
Because there's
I
some
mean,
VTOL, right? There's those
yeah, Joby
eVTOL.
is one of them.
I could see how people could think that the batteries were better because, like, my old Nokia brick could last a week, and you wouldn't
Yeah,
have to charge it. Remember
yeah,
that?
yeah.
But yeah, but I mean, at the same time, okay, my iPhone has to get charged every day, but I mean, okay, my iPhone is like 100 times better than the old Nokia.
That might
Uh,
be
you
underestimating it.
Yeah,
yeah, I
it's
It
mean,
might be
so it makes
thousands to
sense.
100,000.
And the battery has had to advance tremendously to just be able to keep up with all the new features and tech that's in it.
BSG, do you have any? You had a weird portfolio for a while. Do you want to give us an update on the weird portfolio? What is it? What goes into it? And
Oh yeah,
where are you at?
it's basically like a risk parity style portfolio composed of treasuries, gold, and then basically small cap value funds and a real estate fund. It's a vehicle for a lot of my savings, and it's actually having a banner year. It's up 20% this
Lots of
year.
gold.
yeah, gold's helped, huh?
yeah, the chunky gold allocation has helped, and then international small cap value has
That's done quite well
actually,
too. Yeah.
yeah. So like I own AVDV in there, and that's up over 30% this year, and gold is at a banner year. So, and I mean, the philosophy behind that portfolio is to have something that can basically compound at a decent rate over the decades, and then be able to handle multiple economic environments. So you want it to be able to deal with recessions, you want it to be able to deal with booms, you want it to deal with strong dollar, weak dollar, and there's components in the portfolio that should do well in all those environments. It'll never be like the best performing portfolio ever, but if for me, I was just looking for something that would be able to control the drawdowns, and it was almost like my spin on a passive portfolio.
Hmm.
Like in a lot of the financial independence circles, they all always talk about like just going pure market cap weighted, and to me, that didn't make a lot of sense. I wanted something more robust than that. I wanted something where it's not going to decline 50% in the 2008. It's not going to have a lost decade. Yeah, and that's been the whole philosophy behind that. And it served me pretty well. I mean, really, it just helps me stay invested is the big thing.
Yeah.
When I'm freaking out about something macro happening, I can look at that portfolio and say, all
Well, at
right,
least gold's gonna work, or at least this is gonna work.
It's also nice
exactly.
it's nice to have had something that's rallied over the course of a year when you've got something like small cap value, which has been crushed, and you've had something that's rallied and you need to rebalance. So you're taking away from
Yeah, how much of the
whatever
return is
gold.
from that kind of farmer's fable rebalancing?
Yeah, it's a lot of the return comes from that. So you do generate excess returns by rebalancing uncorrelated assets. Like that's the whole Shannon's
Yeah.
demon thing, where like you could have two assets that don't return anything, but if they're over the long run, but if they're uncorrelated and you're regularly rebalancing, you can eke out a return from that. And you see that, like if you were to just average the CAGRs of all the different assets in the portfolio, the actual CAGR, the actual result that you get is always higher than just the sum of the parts, because you do have those times like today when I rebalance that portfolio, I'm going to sell gold and I'm going to buy US small cap value when it's cheap. And potentially small cap value will have a good year. Or in a year like '08, you'll have long-term treasuries up 20%. Okay, well now you can buy some stocks when they're cheap. And that does produce a good effect over the long run. You limit volatility and you get a result that's more than the sum of the parts.
Just on recessions, I know I've been talking about this for a long time, but the 10-3 inversion seems
Whoa,
to
where
have
are we? Inverted again?
well, we uninverted about a year ago,
Yeah,
something like that. And then we've been like basically flat where the 10 and the 3 are trading at the same level. For even though they've both moved around quite a lot over the last 12 months, they've been
in sync.
um yeah, in sync. Well, they've done it, but just over the last few days they've diverged uh going back to normalization pretty markedly.
So you're
I don't
telling me there's a chance.
I don't know what that means, but the uninversion seems to be here for the moment.
I
But
remember you had Cam Harvey on talking about this. That was an interesting
I mean,
podcast.
we inverted in 22. That's how long we've been inverted. It's the longest
Yeah,
inversion by a mile on the record. I mean, on the data that we have, which is
that's a
not.
lot of blood flowing to your head when you're upside down for that long, huh?
I don't know what that means. Like, it's a strange thing where the front month yields less than or the front month yields more than the 10-year.
Hmm.
Not good for banks. Maybe banks look a little bit better when with the inversion gone. But it's also the harbinger of the recession. It shows up 3 to 6 months before the recession.
The uninversion is what is the trigger, is what.
The uninversion is the trigger. Yeah.
And is the extent of the inversion, is that an indicator of of the severity of the
No, it doesn't
pain to
seem to be.
come? No.
There's not enough. There's not enough data point. The N is like 8 or something like that, so it's not big enough.
But that won't stop us from extrapolating
Well,
lots
there
of.
doesn't seem. I just there doesn't seem to be. Although the length of the inversion does seem to have something to do with the length of the
Length
recession.
of the recession. Okay.
And so it's been a very long inversion. So it's
Oof.
possible we're in for a very long
Shit.
recession.
Here
But
comes the
then,
Uh-oh.
nuclear
uh,
winter.
like I've
Yeah.
been saying, there's been an earnings recession, and this is another weird thing from 22, where the 22 was just all of that profit being pulled forward. But there's been a little earnings recession since 22 to date, certainly in small and mid.
Hmm.
And when you say that, that's EPS.
Yes, EPS. Thank you. Yes, it is. Earnings per share.
Yeah.
Earnings per share for large topped out in like beginning of 22 as well. Haven't quite recovered that ground yet. SBC does count for EPS.
Wow, really? It still hasn't recovered?
No, it's below it,
Wow.
below where it
Wow.
was.
What I would say.
Narrative violation.
There's a little bit of a narrative violation, isn't it? Yeah.
Huh. Yeah, you wouldn't
I was
expect
surprised by
that.
that too.
Interesting.
Dude, VSG, we're up on time. If folks want to follow
Oh.
along with what you're doing or get in touch, how do they do that?
Yeah, you could go to securityanalysis.org or values.geek.com. Directs to the same place. That's my Substack. That's where I look for wonderful companies at wonderful prices. And I
Perfect.
host a podcast on the same platform.
Yeah, it's very good.
Yeah.
I'm a fan.
You both
JT,
great guests.
JT, promoting anything?
No, just
Any wise words?
human kindness, I guess, coming into the holiday season. And I think something that stuck with me from the last Berkshire meeting was Buffett said, like, if you've been lucky in life, then you probably owe it to make sure someone else feels lucky. So do what you can to help your fellow human right now.
We'll be back next week. We'll figure out whether we're here the week after that, but we'll certainly be here next week. So we'll see everybody next week. Same bat time, same bat channel. Thanks for tuning in.